We all know that real estate has created more millionaires than pretty much any other business. The problem is, it's also created a lot of heartaches and bankruptcies. Sure, we can get access to a ton of real estate education on the internet, but that's precisely the problem. How can we tell which strategies will consistently produce asymmetric returns and which should be avoided at all costs? My goal is to give real estate entrepreneurs, capital raisers, and investors all of the secrets so that we can grow our portfolios without dealing with costly investment nightmares. And that's what this program is all about. I'm Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast. How's it going, everyone? Today, we have Mark and Josh who are going to talk about how they developed their property portfolio from zero to over $300 million by pursuing some pretty distressed assets in a particular market, and then also how they focus on and are starting to focus more on tertiary markets. So really excited to jump into this conversation. Josh and Mark, welcome to the program.
Thanks for having us.
I know both you guys have a pretty significant background in the business. Mark, I'd like to just start with you, just a quick summary in terms of, how you got into real estate and, what led us to this conversation.
Sure. I'm Mark Shuler, and I am a practicing architect in Washington. I hold licenses in both Washington and Texas. Been practicing for like 35 years. 20 years ago now, I went to the University of Washington, got an advanced degree in commercial real estate development. Took me a few years to find my niche, but for the last 8 to 10 years, I've been focusing on the value add game. I find that that fits my investment profile real nicely and does well for my investors. So to date, I've done probably 14 syndications, renovated a lot of buildings, renovated thousands of units. Knock on wood, never lost money on a deal. Always kind of found the upside, and hope to be doing it for a lot longer.
And Josh, how about you?
Yeah, so I'm Josh. My company is Three Pillars Capital. We're based out of Houston, Texas. And, my start was pretty interesting into this business. I'm an engineer by trade. So
the architect and the engineer, you guys, oh my goodness. All right.
Yeah.
Both Michigan grads, by the way.
That's right. Go blue, But anyway, so I come from a different past than a lot of folks. I don't have an MBA. I don't have a commercial real estate license. I kind of learned this business, on my own, kind of from the ground up. While I was doing that kind of the corporate thing for a while, I was building a single family portfolio in Florida. And I was getting to the point, like a lot of people are familiar with, you buy something, you renovate it, refinance, keep the wash, rinse, and repeat. I was doing that, but it was very, very slow. It was working, but it was slow. And I wanted something more aggressive, something faster. And, honestly, I wanted to, get away from the engineering thing and the corporate role and really dive into it full time. And kind of the light bulb for me went off and decided that, multifamily investing was the path to that. So, kind of relocated to Houston and picked that market for a reason. I'm sure we'll dive into that soon. But what we focus on specifically is value add class B and C properties. So either something that's been mismanaged by the current ownership for years, or, the units they need a facelift, and the rents that can be achieved are much higher than what they're currently getting. And so today, scaled to about $300 million in assets. Mark has been a great partner. He's teamed up with us in a lot of deals to get there. And so I'll dive into more about the uniqueness about our business model. But at the, long story short, we're a fully integrated company. So we do acquisitions, we raise the capital, we do all the renovations, and we do all the management. So that's kind of our edge right there.
Very cool. And it's all focused in that Houston market?
For now, we are branching out into some tertiary markets. We're actually about to do our first portfolio play outside of Houston here, very shortly. So it is an exciting time for us in the company as we're scaling.
Pretty interesting there. So we'll talk more about kind of the changing dynamics of the market and why that's kind of guided you into these more tertiary markets. But obviously, both of you have been in the business for quite some time. As the space generally starts to mature, is there anything happening right now that's kind of making you uncomfortable or kind of making you anticipate a change in your particular strategy?
Yeah, there's at the end of the day, nobody's got a crystal ball, right? You try to make the best decisions you can with the data you have at the time. But, some of the things, the biggest thing that I'm seeing, everybody talks about interest rate risk. Interest rates are rising, cap rates are going to, expand again, and what's going to happen to prices. I think there's a lot more going on underneath the surface than just that. Particularly the inflation, just the expounding and how fast inflation has taken off in the past year. I mean, we had the highest inflation number in December, I think in like 40 years, 30 or 40 years. I mean, that's stuff that's unheard of since the Carter administration. I don't want to play politics here and point the finger at any one person, but the fact is that your dollar is buying you less and less. The same dollar that you could buy for a real estate asset a year ago is going to buy you a lot less of that same real estate asset today. And I think that trend is going to continue. And so if you're looking it's all about tracking where the money's flowing, right? So right now, money is trying to flow into fixed assets, whether it's real estate or anything that's got the ability to just appreciate because of the components that are inside of it. And so I think a lot of that's going to continue to drive and foster, appreciation in this market, aside of everything else that's going on.
So there's obviously a ton of discussion around this right now, but I'd love to get y'all's view on how this plays out, right? So the inflationary risk is real. Renters are getting squeezed, but do you anticipate this is going to put pressure on, let's say, NOI, or do you anticipate that the net result here is going to be favorable for real estate investors? Again, we're not saying whether this is good or bad morally. I'm just interested to get your thoughts, because some people believe that this may put pressure on prices, and others believe that, real estate, for example, is inflation resistant. Obviously, the physical assets are one thing, but also just the potential rental increases could potentially be favorable if you're holding these types of assets.
Well, I think you need to look at this from several different perspectives. I don't know where to fall on the inflation question right now. I was just watching a video yesterday from the IMF, and they're rosily optimistic that this inflation is a temporary phenomenon, and by 2023 it's going to be baked out of the system, and it's going to be all systems go and business as normal or as usual. I've been around the block enough. It's probably my fourth recession. And I know that once inflation gets baked into the market system, it's damn hard to squeeze it out. And I also am very aware that the Fed is running out of bullets. And so, what has worked historically to kind of tame inflation, like I came up when Volcker was chairman of the Fed, and his aggressive actions to get inflation under control, he basically put the economy into a recession. I don't know if the Fed's got that many bullets left. And so I am on the fence about which way we're going to swing on inflation. To answer your question directly, I don't see that inflation necessarily has a direct impact on real estate. It's not like inflation occurs and then the value of assets goes up. It's the instruments that go into real estate that continue to rise. So, all the goods and services that we purchase, that pushes, the cost of doing business higher. The other thing that is ancillary but very real in our line of work is you see more and more and more people trying to get into this space because they don't want to go in the stock market. And so they're looking for fixed assets to place capital. Well, now there is a tremendous outsized demand for, not enough assets. That's what's driving up the cost of the assets right now. Year over year in Houston, I think the prices have gone up $25,000, $30,000 a door. So I don't see that as a direct inflationary response, but indirect, yes. It's psychological. People are pulling the money out of the stock market and looking for anything to put their money in. So it's having a real impact on business models and returns, especially. Yeah, who knows where that's going to be? Hopefully it'll calm down here in a year or two, but we're going to wait and see.
I've been looking forward to this conversation for quite some time, and now hopefully the listeners are kind of getting an inkling as to why. So these guys kind of view the space similar to me, and you're in one of the markets that I think is talked about the most, or one of the top 3 or 4 in the country consistently because of rental price increases, cost per door is going through the roof.
Yep.
In terms of someone who's buying value add deals, some of the things that we've heard about the value add space is that sometimes people in a market such as the one that you just kind of outlined, there's a crazy supply and demand disequilibrium in terms of cash versus opportunities. And you can sell the dream quite easy in those environments with those value add deals. So people may be willing to overpay sometimes for value add when they could buy a fully stabilized asset where the price might be even similar, but you wouldn't have to implement the business plan. I'm sure you guys have seen a lot. I'm sure you guys have lost out on a lot of deals. Would love to get your thoughts on, the cost per door in certain situations where you start to feel like, how are they making sense of this? And just walk us through what it looks like to bid on assets right now in Houston.
Yeah. Josh, why don't you talk about that deal we were talking about the other day?
Yeah. So it's interesting. I can tell you that we probably have to look at twice as many deals now. The volume has doubled to find the same one deal that used to work a year or 2 years ago. And I think it's everything that Mark said. There's so much capital out there chasing so few deals. And sellers are getting smart. They're like, okay, well, I know if I just wait a little bit longer or, blast it out to as many brokers as I can, I'm going to get the best price. And, it's still a seller's market. And it's even more a seller's market than it ever used to be because they know that they're the girl at the prom, the hottest girl at the prom, right? So, basically, I think it all goes back to fundamentals. If it doesn't pencil out, it doesn't pencil out. You cannot force a square peg in a round hole. And I see a lot of people right now doing that. And it makes me nervous, honestly. I've seen a few deal decks. I was talking to Mark about one I saw the other day. And I know what assets trade in some markets in Houston, like really well, and what a healthy range is. And this deal that I saw, and we actually bid on it, I didn't get it, but it's okay. Again, it's a numbers game for us. This person that won the bid, the price per door was so astronomical, yet the projections were, extremely high, 24 IRR, 10 yield over a 5-year hold. And I know how the math works. I know what the loan rates are these days and the leverage you can get. Unless he's getting 40% rent increases, I don't see how the numbers work. But, that's just me and how we've made deals work. And we've been very successful. We've got a really good track record. But a lot of that's because we're very, very cautiously optimistic, because all it takes is one deal and you lose your reputation, right? You lose somebody money, deal doesn't go your way. You don't have the right conservative underwriting in place. I mean, you can really get hosed.
You're only good as your last deal. Hunter, to Josh's point, to follow up on it, I mean, this deal that we were talking about, what I'm struck by is not only the returns that were being promised, but their entry price. We own 5 deals in that submarket, and their entry price is our exit price after 5 years in all those deals. So that should tell you something. There's people overpaying.
Just for context, what is like the price per door? But you don't have to be specific, but I'm just for the listeners that aren't focused on that market, what would be a typical kind of trading value of a price per unit?
I would say, stabilized would be, 105 to 115.
Okay.
And then you could do some light value add and then, juice a little bit more. The heavy value add, if it really needs a lot of work, but the rents can go significantly up, I would expect more, 75 to 90 a door, somewhere in there.
Okay. And so the development risk is like not a factor in this particular niche. Is that right? In the Houston market, I'm assuming it's impossible to develop units at $100,000 a door or something like that.
Yeah, it's a lot more expensive. Mark can speak more to that. It's way more expensive than $100,000 a door.
Yeah, I think the going in development cost, Hunter, is probably 150 to 160 a door.
Okay.
But the significant risk is the time frame. So, we go in, we buy a deal, we hit the ground running, and we've got to renovate it in 22 months. Your development time frame on an apartment deal is 3 to 5 years. And you're going to the hip for the first 3 or 4 because you don't have any income going on. So now you're getting in, these slices of the capital stack where they're getting higher and higher interest rates to get a piece of the deal. So do you have all your development costs covered? I mean, there's just no comparison.
Makes sense. So all of this is to say, a lot of these kind of metrics you're looking at are kind of encouraging you to look outside of Houston. Would love to hear how those conversations are going and what's kind of caught your eye.
Sure. So, obviously, we're still doing deals in Houston. It's not like we can't do deals, and we are. We just did one a couple of months ago. It's just, the pace is a little bit slower than what we'd like. And it's just, again, being cautiously optimistic. It's like, okay, well, can I find a market that was Houston 3 years ago that's kind of coming off the right side and really has got a lot of good fundamentals behind it? And so that's kind of what we put our nose to the grindstone and try to identify those markets where, okay, what do we have in terms of job creation, wage growth, population growth, cost of living, all these factors. And we identified these key markets about a dozen of them. And we just started making relationships with brokers and, other sellers in that market, try to find deals. And we think we've identified a few where that could really be our next hot pocket. But again, trying to find where has the ship not taken off yet, but based on the fundamentals, what's prime for success.
Okay. Got it. And would this be the same kind of value add focus?
Yep. Value add, exactly.
So Houston, I think, experienced a more than 20% rent growth over the last 12 months. And that is really is that fair, by the way? You're in the market.
Yeah, I would say 20%. I mean, for value add stuff, sure. I mean, if it's just gradual rent appreciation, 3 to 5% is what you normally see.
Okay. And so with the last 12 months, it was something like 3 to 5%?
Yeah, year over year.
Interesting. Okay. Got it.
Yeah.
Maybe I was referring to some other data point.
So that's the disconnect, Hunter.
Right.
You've got sort of this organic year over year rent growth, but asset price growth has way outpaced the rent growth. That's what we're saying, is that the math doesn't work and does not support these outsized valuations that people are paying now.
Makes sense. When it comes to the borrowing dynamic, you mentioned interest rate risk. Are you guys using these typical bridge loans with a floater, or are you going agency route? What's really available right now? And what do those economics look like?
I mean, yeah, we do utilize a lot of bridge loans going in. A lot of it has to do with the fact that we do have such a heavy lift on our renovations.
Okay.
It's more efficient for the deal to finance it than it is to raise it in equity.
Mm-hmm.
So that's the reason we use it. And, we always purchase a rate cap on those bridge loans to kind of hedge the risk. And so we run the sensitivity analysis to make sure, okay, if rates spike and I hit that cap, does the deal still work? So as long as that still checks that box, then we're good.
Okay. And what would be like a typical metric right now in today's lending environment? And by the way, for listeners, the bridge loan model is very, very popular in the value add space. And it's basically a requirement if you're going to be competitive. So you have to have like certainty of execution, which is what this team has created over the last couple of years in order to take on that bridge loan risk. But if you're not willing to take on that risk, you either have to have an extremely low cost of capital to the tune of like sub 10%, or you can take on the risk and potentially produce, favorable returns to your investors. But it's very, very unique and rare to have a kind of value add deal without a bridge loan component in today's environment. But just for context, what would be like a typical interest rate you would anticipate to see in today's environment? It's February 1st as of the recording of this.
Sure. Anywhere from bigger the loan, usually the better rate you can get. So if you're doing a $100 million loan, you can probably get a much better rate than if you're doing a $10 million loan, right?
Sure.
I would say anywhere from 3.3 to maybe 3.7. Yeah. Somewhere in that range is what we're seeing with a 75 to 80% leverage.
Makes sense.
And, Hunter, just for your listeners, the nature of a bridge loan is also that it's future funding all of the rehab. So 75, 80% leverage that Josh is describing does not include the CapEx, which is usually financed 95 to 100% by the bridge loan.
Yep, that's
and
correct.
To Josh's point, it is far cheaper and more efficient in the deal to take on the bridge loan because we're only paying that, call it 3, 4, 3, 5% on that money as opposed to 8 to 10 to 20% on investor money. So it's it's a much more efficient path to the same end.
And then agency debt at the end, once the value add has been completed?
Yeah, we refi into agency. We have a pretty fanatic adherence to the renovation pace. So we do 5% of the units per month. So after 20 months, in theory anyways, you have 100% of your units done. You then need to season your cash flow for at least 3 months. So by about month 24, we're pulling that refi trigger and we're always doing agency.
Okay. And so what is happening right now in these tertiary markets? I mean, I understand that obviously Houston's competitive. It is what it is, and you're still active there, but there's a lot of tailwinds in terms of tertiary markets. So I would like to walk through, the thesis here, generally speaking, and some of the conversations you guys have had internally.
Yeah. I mean, the way that this business works is, everybody's kind of first saturating the primary markets, the bright, shiny objects, New York, LA, Chicago, maybe. Seattle certainly has seen massive inflation in asset prices. I mean, I know of deals here that trade for $1 million a door. So then you go to the secondary markets, and Houston is like top tier secondary, believe it or not. And all of those are now getting played out because, it's just too expensive to go. The money just flows downstream. And so it's been flowing into the secondary markets for, 5 to 8 years. And a lot of those secondary markets are now played out. I mean, there's just no more, the math doesn't work on these deals anymore. Or there's so much demand there. It's become an irrational marketplace in these secondary markets. So the only thing left are the tertiary and the sub-tertiary, and you're still, we found in one market, what was the cap rate going in, Josh? Was it 6 or 8% on that one deal?
Yeah, high fives.
I've got another deal in a sub-tertiary market, which is a total unicorn. It's like a 12 cap. And I'm going to squeeze it down to sub 5 and make all that money. So, if you can look in these tertiary markets, I think personally, that's where all the action is going forward. It's where you're going to just see the same phenomenon that we've seen in the primary and secondary markets. You're going to just see massive cap rate compression. And I've already seen that in this little deal that I'm doing. I've talked to the broker last week and he said, yeah, you went in and like this high cap rate. Now it's, legitimately that would be a 6 cap deal going in. And it dropped 6 points in 1 year. Well, 6 months. So that's how fast this moves. Money never sleeps, and it's always looking for a place to park itself.
I agree with that. I'm very sympathetic to this view. I think that there has been a lot of discussion around interest rates and such. And I do think that in the short term, we'll likely see some potential raises. I mean, the Fed has made clear that that's their intention, but the intention does not always align with what really happens. Yeah. And I think what, Mark and I, you've talked quite a bit about this over the last 40 years, that chart is down to the right. And if you were, in terms of interest rates, and if you were investing thinking that they were going to go back to 7 or 8 or Volcker's coming back from the grave or whatever, it's not going to happen. And my perspective is that the intermingling of politics and the Fed is so strong that I just don't see someone coming in and intentionally causing a recession and to say, what's for the greater good, we're going to go through this 17% interest rate period to get things back on track. And if that's the case, then this search for yield is going to continue. Yep. And it's going to go from primary to secondary to tertiary to, sub-tertiary, et cetera. That's my personal perspective. Yep. But of course, there are some potential challenges when you go tertiary. So I want to hear y'all's thoughts on that. Like, where are some metrics that you start to feel uncomfortable in terms of market size, for example, tradability of the asset? These are things that typically come up in these more tertiary markets.
Yeah. That's a great point. I guess I'm going to piggyback off what Mark said earlier. So just to make a clear distinction, when we say tertiary, we don't mean going to some market where cap rates all over the place are 8, 9, 10% just because they're high without any fundamental supporting it. I mean, yeah, you could go to Oregon or I don't know, random market I don't really know anything about, where it's all high because there's not much population or there's not a lot of activity, there's not a lot of economic growth. So naturally things are going to trade a little bit cheaper. So for us, tertiary means like basically where the money has not yet discovered a new place to park itself, like Mark said. And those are the markets we identified, but that still have the strong fundamentals, or the fundamentals are growing. There's an upward trend of the growth. Because by the time a market really, every time somebody talks about a market and everybody hears about it, it's too late, right? It's already, you should have gotten in a couple of years ago.
Which is why we're not telling you what markets we're in.
Okay, fair enough. But let me ask, just to quantify it in some way, I completely am sympathetic to that, especially in these smaller markets. You can move the needle very quickly if you just simply start talking about it. But just so I know, in terms of the level of what we're calling tertiary, would like something like in Albuquerque, New Mexico, something like a Memphis, Tennessee, would these be the types of markets in terms of size or property? Yeah. Okay.
So, and to add what Josh was saying is, we still stick with our fundamentals. I mean, there has to be a certain size of the MSA.
Yeah.
There has to be a job growth story. There has to be an economy. You want to see wage growth and population growth. You want to see some dynamics in that market to support the thesis and convince your investors to place their capital with you. Because, just because I'm investing in, a market over here where the ship's going down, it's sinking, why would I invest my capital there when I have an array of other investment opportunities in better submarkets? So I concur with what Josh was saying. Just because we call it tertiary doesn't mean that, it's your drunk uncle on the sideline there. It's actually a sound fundamental market. We've done our homework. And the one thing that I think is a little bit unique about these tertiary markets, a lot of times they still have opportunity for development activity. Historically, Josh and I have always invested in heavily built out MSAs where there's no more dirt. And so it puts an absolute cap on development activity. So you haven't got a flood of new product coming into the marketplace. So one thing I always check with these tertiary markets is I'm looking at building permit activity. How much new product is coming online, because I know how long it takes to kind of build it out. If no building permits have been filed for the last 2 years, I know it's going to be 5 years before any new product comes online. I'm pretty well protected. That's a good hedge.
Understood, especially given the speed at which you're able to execute those renovations and potential refinance later down the road.
I could be out of that market by the time this new product comes online.
Interesting. So we recently had Neil Bawa on the show talk about kind of the trends that are coming up. And the work from home element is just so massive if you're pursuing the tertiary approach. And I don't remember the exact number, but I don't want to misquote. I mean, there's obviously tens of millions of white collar Americans that do not need to go physically into work anymore. And I think 2 million have moved, right? So it's like very small percentage. And if that continues, that will create a tailwind to these tertiary markets where they say, hey, why would I want to live in downtown LA when I can move to Wyoming and XXX? So is that also part of this vision? Do you anticipate the work from home thing would likely continue and create some tailwinds for the tertiary markets?
Yes, and it has.
Yeah.
I mean, you're seeing cap rates compress across this entire country. And single family home values go up everywhere. There isn't a market in this country where you're not seeing massive competition for single family assets. Now, there are other forces which are driving the increase in prices for single family. I mean, we've had two major economic events in the last 10 years where, construction was taken offline for 3-4 years. And we are way behind schedule on the production of housing. And oh, by the way, the price of a sheet of plywood last year went to $175 a sheet because there was massive inflation in lumber prices.
I don't know anything about lumber prices. You have to put that in context for me. So just what would that mean in terms of like how, on a percentage basis?
Well, houses I was designing, the average lumber drop in 3 months went up $40,000. That's how fast and how far lumber prices spiked because there was just massive demand and not enough supply. We had the perfect storm in the lumber industry. Canada took several plants offline in 2019, and then we had this stupid NAFTA trade war with Canada that put tariffs on importing goods, and it just spiked the price of lumber that we still haven't receded from yet. And you just can't do business in that kind of environment without it having an impact on your bottom line. So all of a sudden, every existing house in Seattle, where I live, has got 20 competing all cash offers unconditional. So people are driven out of these primary markets and they're flooding to the interior. That's why you're seeing states like Iowa just like throwing the welcome mat out and, paying people to move there. If you have a good internet connection, you can work anywhere in this country.
Yeah.
This actually was all predicted back in the early aughts during the .com craze. There was a book I read which just predicted to a T what real estate was going to become and how valuable it's going to become in the the flyover states with the advent of the internet. They predicted it'd take 25, 30 years. And man, they were spot on. You're just seeing if you've got a good internet connection, you can work anywhere in this country. So people are like sick and tired of living in the big cities on the coast and they're moving in.
Speaking of forward predictions, I always want to ask, what your vision is of the next couple of years. Let's say you've got a 5-year timeline. Where do you anticipate, years 7, 8, 9, 10? Do you guys anticipate participating in the tertiary markets until there is a significant correction? And if there is one, what does that look like? A lot of our listeners are always eager to ask the question everybody wants to ask, which is, when's the next recession coming? What are you focusing on to know when it is coming? And what does it look like for real estate investors? So we'd love to get your thoughts on that as well.
I'd say this time around, if there is, when the next recession happens, it's a much different set of dynamics than what occurred in 2008. Banks basically got their wrist slapped really hard following that fallout. And so there's all sorts of regulations and protocols and vetting that they have to do of their customers now. So I don't think it's quite the same boat that we were in back then. But again, I don't exactly know what it's going to look like. I guess my point is it's not going to just plummet out of the sky and just be this 54% production in 8 months or whatever that recession was. I think it's going to be more of like a cooling off period. And I think that's where it comes back to the basics when you're underwriting these deals and you're buying something. How are you hedging your risk, right? Do you have contingencies in place for when these events happened? I mean, are you getting a return because of what you think the cap rate compression is going to be at the exit? That's what I find a lot of people do really risky deals is they make the numbers work because they just drive down their exit cap and they say, hey, look, I got a deal that works. Well, it's because you turned the knob at the end and all of a sudden the deal makes sense. What about everything in the middle? What about your rent projections? What about, the ability to achieve those rents? So I think for us, I'm going to get a little long-winded, but our thesis is Class B and C multifamily where everybody has to have a place to sleep at night, right? And the thesis goes, when you're in a recessionary period and let's say you lose your job, you get downgraded, whatever, you're not going to just go live under a bridge, right? You're probably going to, downgrade your lifestyle to go to a B or maybe even go from a B to a C. And so we're kind of the catch-all multifamily space, right? That you can't really go much lower. I guess go to a D, but we provide workforce housing, right? And we do it in such a way where the units are almost look like luxury Class A apartments. And so we're delivering a product that is so hard to compete with because of our in-house cost structure that, we're doing more than just changing out the floors and putting vinyl and paint on the walls. Like we're doing a bang up luxury remodel. And so for us, that's kind of the buoy, that's the saving grace for when times do get tough. We know that we're still going to be able to keep those properties occupied because our rents are not way, way high in the sky to achieve.
When you say that your anticipation is that the correction would likely not impact real estate in the same manner, what are some of the things that you're using to kind of look at that? Is it the debt, kind of the access to capital, the amount of capital sitting on the sidelines? I'm not trying to poison the well, but those are the things. Yeah, I'd love to get your thoughts.
Yeah, that's a great follow-up question. I think, there's the debt markets are completely different as well since 2008. There are so many more, there's just a plethora more of money that's swirling around that needs to find a home, both equity and debt. Back in 2008, you might have had a handful of bridge lenders to go to get. Now there's like 30 guys we can go to get bridge debt. Mm-hmm. And these guys all have investors that they need to get returns to. And so at the end of the day, it's just all this money swirling around. Everybody can't just lose. I guess theoretically it could, but there's too much money in the system right now that I think it's a lot harder to unwind that and have everything come crashing down.
I'm very sympathetic to the comments about the volume of transactions, which is created by the number of participants. And this is a big difference from 10 years ago. We didn't even have the accredited investor meaningfully participating in the world of real estate. And that has kind of flown through from the institutions all the way down to accredited investors, where now, like you said, you have many, many bridge lenders. So what this means is that it's not functionally a stop loss, but there are more people willing to bid if others are not willing to participate. So I agree. I don't think that this whenever it happens, what kind of stage in the cycle are we currently in? What are we in the first inning? We just had this weird COVID recession, which wasn't a recession basically, though it was the most pronounced decline of GDP growth in the history of the country or something. I really don't know what to make of it. But my view is that the Pandora's box, which was open in 2008 when it comes to quantitative easing, is not going away. And so if the markets correct significantly, not only is there going to be political pressure to push that button, I don't even think it's going to be required. They pushed the button so quickly when it came to COVID that we didn't really, not only do we not feel it, net income went up across the board in each quadrant of income. JP Morgan reported on this, where people made more money not going to work across the board, from top incomes to the bottom. And I just think that that's going to continue until it can't anymore. So that was a bit of a rant, but would love to get your thoughts. I feel like the real estate investors that are participating intelligently stand to gain quite a bit if that in fact is the case.
The low-hanging fruit in this is the people who aren't doing what Josh described, which is sticking with the fundamentals. We go into a recession, interest rates start climbing, a lot of people are going to shake right out. That's when you're going to see some opportunities, because it'll take a third of the wannabe syndicators offline, I would hope, and provide better balance to the market. There isn't this sort of irrational demand for product that we're currently seeing. So hopefully we'll see a little more rationality creep back into the system. This business, you just got to be the last guy standing, and there'll always be deals there. But you got to, and your viewers don't know this. This business is nothing but a huge math problem. The Excel spreadsheets we run on this stuff are just sheets and sheets and sheets long. And, it's pretty simple. Either the deal works or it doesn't. It's where people get in trouble and where I think there's going to be opportunity going forward, and what is going to be for those guys who just cook their numbers and make over rosy promises to their investors, and then things don't work out and they lose the house. If we see, some tightening of markets and slight rise in interest rates here to slow things down, deheat the economy, we'll just have to wait and see. Like I said, it's, the next year or two will tell us.
I think just to add to what Mark's saying is, being in this space now for almost 5 years, and because we have our own management company, the value is created on the ground. If your operations are not solid, you will not do well, especially if you're overpaying. Not to say that the third-party model doesn't work, but I see a lot of inefficiencies that go on the ground, especially when we take over property where the management prior to us was very poor. There's just some very obvious things, a lot of money being wasted, a lot of rent not being collected, a lot of policies not being followed to keep a tight ship. And you can easily take a deal that was running well and completely ruin it if you don't have your operations tight. And I think a lot of people overlook that point. They focus on the beginning part of the equation, which is raise the money, find the deal, close it. Okay, move on to the next one. But then they kind of overlook that middle part where it's like, well, you got to create the value by running it well and achieving your business plan. And so kind of adding to what Mark was saying, the last man standing. I think when a recession occurs, the last people standing are going to be those operators that know their stuff. They know how to cross the T's, dot the I's, and know every single detail involved in running the ship.
Couldn't agree more. I have been investing because of how we're positioned in the space. I've been able to invest across multiple different partners to the tune that most passive investors, but especially active investors, have not been able to do. I have a very good insight in terms of what it takes to make quite a bit of money in real estate because I've been able to work with so many great teams. And I'll tell you, it is not the market, it is not the asset class, it is not the risk profile, it isn't even the personality of the sponsors. It is who is obsessed with operations the most. Operations. That's what actually matters. Now, you can be obsessed with operations and not do a good job communicating with investors, and maybe you're going to burn a few investors, whatever, but you're probably not going to lose money. You know what I mean?
Yep.
So I
100%.
really like that. Yeah. The focus on operations, the absolute obsession with getting things done on time and on budget. That's really going to be the key determining factor in terms of who succeeds going forward.
If you think about this, Hunter, piggyback on what you're saying, all value creation in any deal is through operations. It's the only place you can create value, because value just doesn't, it's not pennies from heaven. You got to work for it. And to Josh's point, there's where a lot of third-party operators kind of miss the boat. It's just so expensive to bring on the third parties. All of our rehabs, we do them for 50, maybe 60% of what a third-party operator can do them for. And certainly we're a lot more lean on our management side as well. So,
yeah. And rising tides raise all ships, right? So it's very easy to get yourself bailed out in an appreciating market. If you didn't do well, you can very easily gloss over the poor performance and say, oh, well, this guy's willing to pay me an extra 20% on it just because the market's hot and get out. And I've seen a lot of that happening too. A lot of guys that they got lucky, right? But at some point, the luck will run out. If you don't have the operations tight, you will be in pain.
So fundamentally, what we're describing here, just again for your listeners, there's two types of models that you can take to this business. You can take the fundamental value add, value creation model where you actually roll up your sleeves and you get to work. I've seen another model, and it's really prevalent in the primary markets, or has been. We'll see what goes on from here. But certainly in Seattle, let me kind of personalize it. I've seen a lot of investors buy an asset and then bet on the come. And we've had so many tech workers move to Seattle, and there's such a limited supply that rents have just kind of kept going north for the longest time. So they're betting on a future value now without having to do any work. It's a dangerous game to play, especially when you hit a recession. And in the pandemic, downtown Seattle was 30% vacant. And a lot of people were losing their shirts. And, oh, by the way, it's the bluest of the blue. We still have eviction moratoriums here, and we're still not getting paid by our tenants. So how long can you hang on?
Tough. All right, guys. Well, look, I'm just kind of excited to have this conversation given the pivots you guys are making. I know you're still participating in Houston, but just with everything going on, it's a very interesting time to be investing. But I think the people who are obsessed with operations, intelligently participating, and are not willing to adjust their underwriting standards to where they feel uncomfortable, they're going to be the winners. So Anyway, really, really appreciate you guys coming on. Before we jump off, though, let the listeners know how they can learn more about you and your firm.
Sure. So again, my name is Josh Welch. My company is Three Pillars Capital. So the website is all spelled out, threepillarscapitalgroup.com. You can hit the contact button and send me an email if you want to connect.
And I am Mark Shuler, and you can reach out to me at mark@sgreinvestments.com. Again, hit the contact button, reach out if you have any questions. We love to talk about this stuff. We're a couple of nerdy engineers.
I should have mentioned Mark is a Raise Masters member of our mastermind. He's an excellent contributing member of our community. So thanks again, Mark. Thanks, Josh. Really appreciate it. And we'll link to that in the show notes page.
Thank you.
All right. Thanks.